today. And we will be recording this so that folks who couldn't be here can have access to the information. So again, thank you for being here. And Erika, thanks for leading us today.
Thank you, Tina. It's my pleasure to be here and to pull together this amazing group of folks that I've been able to work with over the years as this impact investing in the alignment and embedding racial equity has become more central to the work that everyone's doing. And so I also want to thank you and the Bera Foundation for actually making this available to a larger group of foundations. I think it's incredibly important that we're modeling as we're going along. And so instead of just sort of getting what the Bera Foundation needed and moving forward, you actually made this an opportunity for others to learn and to advance their work as well. And I'm definitely appreciative of that. And I'm sure other members of the Philanthropy Network are as well. So in terms of background, which you did provide with the Philanthropy Network and the Mission Aligned Investing Collaborative, the purpose of this conversation today, it's sort of like a 200 level discussion. So I know over the last year, a lot of foundations have really pressing or boards and investment committees are starting to press as well some of their consultants and asking questions about how to embed impact investing more deeply into their endowment management practices, as well as racial equity in those practices. And so this is still an emergent field, just the field of impact investing in and of itself. So when you think about grant making, and Bert, Feuss and I had this conversation a couple of days ago, when you think about grant making practices, they're like 100 years old. Like people have, kind of figured that out and refigured it out. And, that's even transforming in terms of some of the movement on racial equity today. But impact investing is really new in the scheme of things. And so as an emergent field, we're going to continue to refine and evolve and learn and transform and pick apart some of the practices that have really held a lot of the systems in place that have been creating even the need for the philanthropy that foundations are providing. And so this conversation is one about what are some of the ways that foundations who operate under a particular mission can actually start to leverage their role as asset owners within the system, how to think about actually embedding racial equity deeper into your endowment management practices, but then also how to think about working with other actors in the field, specifically different types of consultants and external support to get the results that you want for your policies and practices. So we have some specific objectives for today, and I think we'll get to all of them. And we do have held for this conversation 2 hours to ensure there's plenty of time for questions and some deep dives on the concepts that may be shared. But we don't have to use all that time if it's not necessary. But I did just want to let you know that we will be here if there are questions that come up or if folks need clarification on anything that they hear. So in terms of those objectives, we wanted to talk about different models for engaging external consultants and different types of consultants that may be engaged to support foundations as they go down this path. So who's available in the ecosystem for advancing mission alignment and integrating impact investing and racial equity in your practices. Then thinking about some of the key considerations and recommendations for launching an actual RFP process. So when I was chatting with Tina, she was saying like, this is relatively new for the Bera Foundation to approach their work this way and to release an RFP at the same time. And so there's a lot of learning that's going on across the board. So again, it's emergent. And so having this shared space to do some of that learning on what you might be thinking about or should be thinking about in that process is going to be helpful. And then finally, the third objective is to really start to assess the racial equity competencies and the skills that you should be looking for in firms that you may be engaging or thinking about what some of the considerations for even racial equity in designing your RFP itself as you move this work forward as well. And so before I introduce our panel and then ask them to provide a little bit about their backgrounds, I did just want to sort of level set a little bit for where we're entering the conversation. I don't know if this is a new one for some folks, but I do know that the Mission Aligned Investing group we've met before. We've had the conversations around racial justice and racial equity in impact investing and in endowment management practices. And so just a reminder that the conversation that we're having today is at the level of institutional and systemic manifestations of racism. And so thinking really closely about policy practice and sort of the cultural norms that have been shaped around decision making when it comes to capital allocation. And so less about implicit bias, but maybe a little bit about how that actually shows up in decision making, but really again focusing our conversation and this work at that level in particular. So with that, we have this really amazing panel of practitioners who have had various roles in their careers as asset allocators, as consultants, as board members, investment committee members. Like, you're getting a little bit of everything here with the conversation today. And I will make a really quick intro for each of them, and then I will ask them to talk a little bit more about anything in particular, and then we'll just dive right into the discussion. So we have with us today Bert Feuss, who specializes in the alignment of investment capital and practices with mission to advance racial equity, inclusive economies, sustainable growth, and healthy communities. Thanks so much for being with us today, Bert. I've known Bert, been working with him for, I don't even know at this point, probably at least 10 years. So Bert was formerly the Senior Vice President for investments at the Silicon Valley Community Foundation, which is where we met when I was working at AbbVie and really starting to build capacity for this work. We also have with us Orim Graves, who I've also been working with for about, 10 years as well. Orim is formerly is the Executive Director of the National Association of Securities Professionals for more than 10 years, where he was advancing the mission of promoting diversity, financial education, investment, and advocacy across the financial services sector. And so thank you for being with us today as well, Orim. And then we also have Susan Hammel, who, another one. We've been at this for a while, so there have been some folks who've been trying to get this stuff done in the field for some time. But Susan translates between mission-driven change makers and expert investors. And so she's with Cogent Consulting, and I will actually ask each of them to talk a little bit about their background, and then we'll kind of dive into the question. So Bert, I'll come back around and start with you.
All right. Hi, greetings, everybody. Bert Feuss. I'm a senior advisor with Community Capital Advisors. I'm located in San Francisco. As Erika described, we're a boutique national advisory focused on place-based investing, impact investing, and overall helping funders of different types, community foundations, family foundations, health funders, align their capital with their mission. Prior to that, I was with Silicon Valley Community Foundation for 16 years. I was Senior Vice President of Investments, oversaw all the investment activity, growing the assets over that time from under 2 billion to over 10 billion, numerous portfolios, endowments, pools for donor advised funds, custom separately managed donor advised funds, charitable trusts, and managing the complex gifted assets, real estate, crypto, limited partnerships, you name it. So that's a little bit about my background.
Thanks, Bert. Orim, if you can tell us a little bit about your background and what you're doing now.
Thank you, Erika, and thank you for having me. It's truly a pleasure to be here. My background, I currently run a small consulting firm designed to help along this continuum of racial equity, investing, social responsible investing, plugging capital gaps where they're needed. So doing just quite a few things there. My background, I'm a former commercial banker, trained as a banker. I've been in the investment industry longer than I would care to admit. I have experience in a major investment consulting firm. I have worked as a chief investment officer for actually the dear city of Philadelphia a while back. What else have I done? Oh, so most recently with NASP. I also have experience with a diverse owned fund of funds provider. Currently, I chair the investment committee for a small HBCU in Louisiana. I am on the investment committee for the City of Detroit Police and Fire Pension Fund. Just finished working on the CFA's code and principles for diversity, equity, and inclusion. So just put the wraps on that. Just, I've been around a little bit. Thank you.
Thanks so much, Orim. And Susan, if you can share a little bit about where you are now and your background.
Absolutely, part of the 10-year club with you, Erika. And that's saying something, because in the last 2 years, everyone started talking about racial justice, but we've been talking about it for 10 years. So my name is Susan Hammel. I'm the founder and president of Cogent Consulting. We're an impact investing advising firm based in Minneapolis, working with foundations and corporations to help them invest in line with their values. We've advised on almost 200 million and helped place that into impact investments, that money for deep impact in place mainly. Orim mentioned the CFA. I'm also a chartered financial analyst. I got my start in traditional investing on Wall Street at Prudential in the 90s. So not a banker, Orim, but a private placement person. So my background is more on the debt side. Trained up in traditional finance. And because I was a philosophy major undergrad, I kept asking a lot of why questions. Why are we doing this? Why does it make sense? And luckily, Prudential had an answer. They had an impact investing shop even back in the 90s before it got popular. That's where I got my start. And that's where I got hooked to impact investing. And we do believe at Cogent that money can be a force for good. It also can be a force for bad. And not paying attention to where the money is invested can make an impact. Every investment makes an impact, whether it's called an impact investment or not. So I'm really excited to be here with you today. I'm also my 7th year serving as executive in residence for impact investing with the Minnesota Council on Foundations, where I'm on call to the 150 members of the Minnesota Council on Foundations. I'm also on the board of the Trillium Family Foundation, where we're committed to combining racial justice and climate justice. So very excited to be here with all of you today.
Okay, thank you so much, Susan. I appreciate it. So as you can hear, the panel that's been assembled today has just a broad range of experiences, but the consistency is the focus on racial equity in process and in practices, and even thinking about, again, how to transform the entire body of work that everyone is doing right now. And so I did not do this before, but one of the things that I want to make sure that I do is, for the purposes of this conversation, define racial equity. And I'll put it in the chat as well. But the definition that I use is that racial equity is the condition that would be achieved if one's racial identity no longer predicted in a statistical sense how one fares. And so I put that out there so that we can, have a shared definition and kind of keep coming back to that. And it's one of those things that sort of requires us to then think about like the data. It requires us to think about what's driving the particular system of advantage and disadvantage that we actually would need to have a concept of racial equity in the work that we're doing. So with that, I'm going to start asking questions of our panel. And the way that we'll do this is there's one question that I want everybody to answer initially, and then I will kind of target questions to each of the panelists let them kind of go for 5 to 7 minutes and maybe some slide decks. And so please, feel free to ask questions as we go along. And like I said, we do have time to dig in on some of these concepts and ideas. So one of the things that I just wanted to start with was, as these foundations are considering going down this path towards impact investing as a deeper part of the endowment management practices, and also incorporating a racial equity lens in that work. What is at least one from each of you? Just want to know, like, one decision point, one resource, one idea that you would strongly recommend that decision makers prioritize as they approach this work. And so if it's policy review, if it's agreement, learning, what is one thing that you would want folks to make sure that they've got front and center as they are starting to go down this path before they release an RFP or anything? So Susan, I'll start with you.
Great, thank you, Erika. I think to probably state the obvious, the foundation, the first thing is to get your ducks in a row and know what you want. Know what are your hard and fast, absolute minimum requirements for an investment consultant, and know what kind of your next tier requirements are. So we call those the minimum requirements, and then kind of the selection criteria between firms. And when it comes to racial justice, it's a little tricky right now because everyone's talking about racial equity. And thank you for that definition, Erika. I think people throw the term around and don't really know what it means. So it's helpful to have the definition. But every single investment consultant is talking this talk right now. The question is, do they walk the walk? And how do you tell? Because they're going to trot out hopefully a diverse team in front of you to get your business. So I think you have to be really clear about what you're looking for, and think about what are some things you actually won't compromise on. Does that have to do with performance? Does that have to do with racial justice? Does that have to do with the impact you want to make, and then your budget? So I think the one thing I would say is to really know yourself, what are your absolute minimum, and then put the rest into selection criteria.
Okay, thank you. Orim, let's go to you. What's the one thing before heading down this path?
Like Susan, I agree 100% with what she pointed out. I'll just raise a couple of things. Again, the terms get thrown around, I won't say loosely, but interchangeably. You've got ESG, you've got impact, you've got racial equity. And they also tend to reside on a continuum of capital, from public to basically private, small direct investments. And so you need to be very, very clear on what your expectations are. So I would say that integrating your values and your mission for this work is key, and making sure that the values and the mission are actionable and investable. Because it doesn't do you any good to say, I want the world to get along better, but can you invest in stock that says you want the world to get along better? Much of where we are, in this process of moving along the transom to utilizing our assets in a more productive, climate-driven, racial equity-driven fashion. We're still in spring training. We haven't even started the game yet, and so it's therefore, what you think you know now, you will evolve to know something different shortly therein. So I know I'm raising more than one point, and I apologize, Erika. But fundamentally, the last thing I'll say is have a clear path where you want to go. What does success look like? Because once you drive an RFP, and if you're not clear on all of these factors, then you're just going to pull your hair out trying to figure out who to select and what the metrics should be. So I'm sorry, I went over my number of factors.
That's fine. We'll actually probably come back to a few of those as we go on. So Bert, what's the one thing that you would suggest folks think about before they step into this process altogether?
Well, I definitely agree with everything Susan and Orim said about having a North Star and really, know yourself first. I think I'm going to focus on the governance that when you're attempting to implement something new, you've got to move everybody forward, and not everybody moves forward at the same pace. And so think about, in my experience, going down this path is an iterative learning process, and there's a process of discovery throughout the entire journey, but especially in the beginning, as you're trying to define that North Star and what it is your priorities are and relative priorities. And then bringing the decision makers in particular, but all your stakeholders, internal and external, kind of along with you on that discovery journey it's a slow process. It's not a fast process. So I've heard one practitioner said, power down to power up, like take time to understand your history, like why do you exist and how. And in particular, if we're talking about addressing racial equity as part of your impact strategy, how is your organization, where did your wealth come from? How is that extractive from people, from resources? And what are you doing to either perpetuate that or to actually address larger systems level change? So I would say, think of this as a learning journey, do the deep thinking and bring people along, I guess is my main point, is think about how you're going to bring people along with you and how you and you with them on this journey.
Okay, thanks so much. So all excellent advice. So thank you all for setting the stage for how some of the pre-work needs to unfold for different organizations. Okay, so now we're going to jump into some questions about some more of the nuts and bolts of the discussion. So we're thinking about that first objective in terms of models for engagement and the types of consultants that are out here. Folks might be considering a number of different approaches to deploying capital from the endowment. So it might be direct investments, it might be place-based investments, social enterprises and supporting social enterprises on the ground, or operating through intermediaries like fund managers, CDFIs, fund of funds, et cetera. So Susan, I'm going to start with you. And I know that you have worked with the collaborative on a few projects, and conducting due diligence and helping people start to develop that capacity as well. So could you share sort of a general frame for how to think about why foundations might consider a place-based approach in particular as part of their overall strategy? When is this a good idea to do it? If it is part of the impact strategy, what are some of the ways that consultants are engaged to support decision makers? And then how do you really expand the understanding of how to make these types of investments to advance racial equity and racial justice?
Thank you so much, Erika. I'm going to share just a couple of slides here for those of you who are visual learners to help kind of frame the discussion. I'll try to make sure I answer all your questions, Erika. So this is how we look at investing. And you're a foundation, you make grants on the left and you do investments on the right, and never the twain shall meet. That's the old way of thinking. And that's what's completely changed. And what's happening is traditional investing is going away and it's becoming responsible investing, sometimes called ESG investing. This is where the screens kind of values aligned, do no harm screens come in. But we're also seeing philanthropy change from just making grants to being more partners, more like venture, kind of benevolent venture capitalists, so being partners with community in getting deals done that wouldn't normally get done. And then in the middle, we have impact investing, which has that positive measurable impact, and it can be a below market rate of return, a PRI, program related investment, or it can be a market rate of return, sometimes called an MRI or a mission related investment. And along this spectrum, there are different ways you can get some help, but I think the first question, Erika, that you asked is why? Why would a foundation want to do this? So right now, the foundation is pretty happy in traditional investing. So gives away 5% of its assets and got the other 95% invested in various, the diversified portfolio in the markets. So why would you want to move through this continuum? Well, number one, there's kind of 3 M's is the way we look at it. So there's money, morals, and mission. So for money, right now, the traditional investors are missing out. By not looking at racial equity, by diverse fund managers, by diverse individuals launching companies, they're missing out on talent. So they don't see that talent, some of them, because it doesn't look like regular venture capital, because regular venture capital investing looks very white, very male. In fact, a great deal of venture capital goes to white men who graduated from 2 schools, Harvard Business School and Stanford Business School. So not to knock those schools, but just think about all the talent out there in this country and in the world that these traditional investors are just missing. So if you really want to make some good investments, see things other people don't. That's how you're going to get that alpha return. So money, do it because you can make money, and you make more money, give more away. Great. Second reason is morals. I think many of us read and were really affected by Edgar Villanueva's book, Decolonizing Wealth. I have it right here. We can put it in the chat, but there's a whole chapter on investing. And to Bert's point about knowing your history, where did this money come from? Or another way of putting that, on whose backs was this money earned? What are the origins of the money from the foundation? There's foundations who the money came from taking land from Native Americans. So to decolonize wealth, there's a moral imperative to look at values and do no harm and do the right thing and move into impact investing. So make money, do the right thing. So money's morals, and then mission. Every foundation, you're tax exempt. You got a tax exempt exemption from the IRS. At some point in the history, somebody got a tax write-off. So how does it make any sense whatsoever for a foundation to have all this investment tied up in companies, organizations that aren't aligned with mission? You're a tax exempt institution, so shouldn't all the money be values aligned and do no harm? So what we see, those are the whys, so money, morals, and mission. But Erika also asked about, okay, so let's say you're convinced you want to do it. Now, how and where can consultants help you? Erika's first question of the day was the prerequisites to launching an RFP. Well, these are our prerequisites to doing impact investing. Impact investing as differentiated from responsible investing, meaning it's measured. The impact is measured. So some of the prerequisites you have to hit on are your organizational capacity, your investment policy statement. Bert talked about governance, your knowledge of the impact market, your impact investing themes, and your budget. These are some of the things that a consultant can help you think through these buckets in terms of coming up with a strategic portfolio design where you launch a market scan, seeing what's out there in your themes, according to your budget, developing an allocation matrix per theme and a forward calendar of investments, and then due diligence. A consultant can help you all along these different milestones. They could be an advisor with the prerequisites, just helping you walk through the process. They can help you design a portfolio, and they can just help you with due diligence. And, you know, at my firm, we've had foundations ask us to do all of the above. Some just say, you know what, we've got all the rest covered. We just need help with due diligence. So really, as a foundation, you can think of where in this process you need help. And then when it comes to actually the steps to making an investment decision with a racial justice lens, you have to bring that lens throughout the entire investment process. So starting with sourcing, you have to, if you're just going to talk to the same old people who you happen to know, that's a very exclusionary process. So to incorporate racial justice, you've got to start with your sourcing, and a consultant can help you with that and bring you through the process of an initial review. Does this make sense? An impact review, does this meet our objectives? Into a risk assessment. And you have to be really careful there because a lot of bias creeps into the risk assessment process. You know, Erika launched off our workshop today with a talk about all the biases built into this process. So you have to take a different approach to risk assessment, and then the financial analysis and the closing and monitoring process. So Erika, did I hit all the topics that you wanted me to cover?
Yes, I think you did, and really appreciate hitting on the fact that the racial equity lens has to be throughout the process. That's not something that you can kind of decide halfway through, oh, that's right, that's something we wanted to do, or sort of predetermining, we'll get to that then. It really is something that has to be from the beginning, to your point, in even the prerequisites, and then brought through all of the practices and the approach. So thank you so much, Susan, for that. Okay, Bert, I'm going to turn to you and ask a little bit about when using more conventional investment consultants, you know, what are some of the different models that are out there? So what are the different ways that foundations can think about the array of services that are on offer, and how those things are structured, and what are some of the differences among them? So I know you usually talk about discretionary, non-discretionary, and hybrid models. So if you could share a little bit about that, and also in your experience and from your view, how are some of these more traditional consultants, how are they faring on impact investing and racial equity as well, as that is an expanded approach that investors are taking?
Great, thanks. And I too have a slide or two that I can share. So let me do that. Another spectrum, which is helpful to kind of give context and how we think about the investment consultant field. So if you, this slide shows on the left non-discretionary, where the investment committee maintains authority and all signing authority. And on the right, the other end of the scale, full discretion is delegated to a third party. These are sometimes called outsourced CIOs or outsourced chief investment officer models, where you're giving the investment advisor full authority to act on your behalf. And in the middle, there are hybrid approaches, and there's a variety of hybrids, and I'll go into that in a bit more detail in a second. But think of this as a continuum, and I would say overall the trend is kind of towards the middle, that you're seeing your traditional consultants adding more capacity to handle particularly the administrative functions, and taking that burden off of staff, and that the outsourced CIO models that many years ago began with a single pool that everybody invested in the same pool and you got their best thinking. They're finding, especially with funders wanting specific thematic overlays and to embrace diverse managers and other customization, that they're needing to provide more customization and are also starting to move towards the middle. But let me just summarize kind of quickly. On non-discretionary, you generally have your own portfolio, so it's customized. The investment committee is setting policy and strategic asset allocation based on input and recommendations from the consultant. The consultant is vetting managers and bringing those managers to the committee for approval. You often, but not always, have a separate custodian custodying the assets. As I mentioned, there's no signing authority by the investment advisor. From an administrative point of view, you've got multiple accounts typically to reconcile in the accounting office. On the discretionary, going back to the other side, these are either single pools, like maybe McKenna Capital, you've heard of, or as Global Endowment Management, GEM started out as with one pool, everybody's in the same pool. That's evolved over time to a building block approach where you can customize into different asset class pools, but you're still commingled with other investors. The outsourced CO has full discretion over the selection of managers in that portfolio or in those pools. And they're doing all the cash movement and transfer on your behalf. And one of the pluses from an administrative point of view is that it's often a single LLC, a sole member LLC, so it's a single account to reconcile. Now, in the hybrid model, I'm going to flip to another slide here. This really varies by organization. So on the left, you have the client, the foundation, and which duties they're responsible for. And on the right, this is a slide that I borrowed from Makita Investment, independent consulting company, and which responsibilities they're maintaining. But this can really be customized to each organization. The investment policy and strategic asset allocation is always the responsibility of the funder. But if tactical allocation is part of your approach or your consultant's approach, then that might be delegated, that they can have authority to do that on your behalf. In some organizations, they feel like they don't have expertise around private assets, so they delegate that to the consultant. I've seen it the other way, though, I think more typically, where manager, you can fire them at any time, whereas a private asset, you're stuck with them for the life of the fund. So often committees say, no, we do want to make that decision, bring those recommendations to us. And then the level of fund coordination, again, I think the trend here is outsourcing, regardless if it's non-discretionary, full discretionary, is giving your advisor authority to sign papers and sign subscription docs on your behalf. So that's just a brief overview of these different models. To your second, and there's a second dimension to this, which is the type of firm offering these services. So if you think about, is this an independent consultant who's, they don't manage money, they don't sell products, they're not affiliated with any other organization, they're really paid for just their advice and their ability to generate performance? Are they part of a larger wealth management firm or an investment banking firm? Is it a bank or a mutual fund company? Excuse me. Or a small boutique RIA that can customize, and where, the type of organization they are, and also influences the flexibility, where they're sourcing capital, how they're incented to drive performance or meet your investment objectives. So those are all dimensions you would want to consider in determining an RFP selection, who's going to be in your recipient list. To your second question, let me just grab some water here. So how is this evolving, and how are investment advisors responding to demand for impact investing, greater ESG integration, allocating money to diverse-owned firms, women and minority-owned asset managers? I would say that there's a couple of things happening. On the whole, your traditional investment consultants, I'd say, are not doing a great job. They're either bringing on talent because they're saying we're going to commit to doing this, and they're hiring and bringing in talent in impact investing, in ESG integration, in sourcing diverse managers, or they're collaborating and bringing in a specialist firm, somebody like Susan or my organization, to help fill the gaps where they don't have the networks, the knowledge, or the insight as to how to source and build an impact portfolio. And I would say that the deeper the impact, particularly if you're talking about concessionary capital, funding, say, CDFIs that are investing in low-income communities, affordable housing, healthcare facilities, the more you skew towards that as your objective, the less a traditional investment consultant and investment advisor have the capacity to do that. And you're going to see either collaboration, bringing in a third party, or just completely outsourcing that part of the portfolio to a third party. So on that spectrum that Susan showed of PRI to MRI, if you're trying to align, say, your cash and your short-term reserves with your mission, that's something that I see very, very challenging for traditional investment advisors. If you're trying to do a loan fund that's providing catalytic, low-cost patient capital to local communities through CDFIs, that's not something a traditional consultant is generally going to have the ability to do or have those networks. So bringing in a third party or partnering is going to be the solution set there.
Okay, thank you. And we'll make sure to send out the slide decks following, so everybody has the resources. So Orim, I want to turn to you for a particular view on this as well. So when I first started working, had my first exposure to capital markets, I'm working at an institutional asset management firm. It was a Black-owned firm based in Baltimore, and the way that that firm was gathering assets under management to grow and to kind of get on the radar was through a manager of manager relationship with an intermediary. And one of the things that I've always found remarkable is how public pensions, and you talked about doing your work with the city of Philadelphia as a CIO and some of the other work that you've done with pensions, actually have a number of models for how to grow opportunity for diverse owned firms. And a lot of the growth of certainly Black owned firms and women owned firms came because of intentional strategies that were being developed by public pensions. And then even the transparency in that process kind of let people know how they were, to approach and where opportunities existed. And then even the growth of manager and fund of fund platforms. So when we're talking about that in particular, right, like the diversity of managers and the use of some of these platforms, can you just share a little bit about how that fits into this puzzle that we've been starting to put together today? So talk a little bit about the use of fund of funds or manager of manager platforms for exposure to diverse managers, and then why might foundations opt for these types of models as well, like including that in their process to advance racial equity in particular.
Thank you. And that is a very good topic I believe, for this group in looking to gain exposure to diverse firms, BIPOC firms, gender-based firms. Fundamentally, what these firms are designed to do is replicate a benchmark. It could be a customized benchmark. It could be just a static generic benchmark through aggregation of individual firms to make up sort of a consolidated return, adding value over and above the benchmark that you are looking to target. This sector has evolved in that initially it was focused on domestic equity primarily. There are fixed income applications, there are global equity applications, there are emerging manager applications now. So there are applications across the full dynamic to engage on a fund of funds basis with diverse firms. There's application across the full spectrum of asset classes and allocations, and specific. And it also, you can get exposure in the private equity side of the ledger as well. So for those of you who are looking to your private equity portfolio may be the place that you want to try to inject some diversity, you can get to a fund of funds provider as well. A lot of these a lot of the firms that are available to you in this space have track records at least 10 years. They have assets under management, in the billions of dollars at the moment. Obviously not in every product or asset class, but if you aggregate the firm level, they would be north of $1 billion. They have exposure to all client types, as Erika mentioned. The public sector has they got the joke early, or they got woke early. They have been in this game at the beginning. They were in some respects, they actually seeded some of these firms to provide a diverse product to them. These firms, again, they have exposure to the corporate sector as well, Taft-Hartley and endowment sector. So you can get exposure to these to diverse owned and managed fund of funds. Now, how do they do what they do? Fundamentally, they find managers that it would take you longer and your consultant longer to find. So they have access to managers who are startup teams pulling out of a larger firm who can bring over a track record. They will fund those types. They'll fund managers that have a specific mission. It could be just as simple as top 100 large cap value companies, just to say. They will find diverse owned firms in every corner of the globe because that's their business. That's what they want. That's how when I say their returns are important, their biggest asset is the managers that they bring together to provide that fund of funds product to you. It's a very sophisticated. They use sophisticated asset allocation dynamics to pool managers together. So it's just not a willy-nilly. They look at the manager's tendencies, how they may drift in terms of capital, style perspectives. They factor all of those things, risks, obviously. They factor all of those things into formulating a pool of managers. Generally, the pool will be 5 to 10 managers. You'll have liquidity as you would have in a generic product. So you will, if it's obviously in the public sector, if it's public equities, you'll have real-time liquidity. The evolution of this business has been that the fund of funds managers have taken a more holistic approach in assisting their emerging managers, or the managers that they put into their portfolio of the diverse managers, in that they also provide back office help to the extent necessary. They will provide access to systems whereby it makes it easier for them to assess and analyze individual stocks in their portfolios. They will, introducing the firms to their clients in the event that those firms graduate outside of the fund of funds into a direct relationship, which is fundamentally what many of these firms want to do. Actually, all of them want to graduate to a bigger allocation. So they don't want to necessarily stay contained within the fund of funds metric, but they're happy. I mean, they're happy to, because it gives them access, it gives them assets under management, and it reduces their marketing budget, so that fundamentally they don't have to cover as much ground as a manager would in trying to get out to visit potential clients all over the globe. So in the realm of trying to get exposure to diverse managers, this is I hesitate to use the word simple, but it's a very efficient. I won't tell you. Obviously, it's cost effective to a certain extent. Obviously, there's an extra layer of fees that you would pay because you have to compensate the fund of funds manager, and then they in turn compensate the underlying emerging or diverse manager group. So there's an extra layer of fees, but those fees generally are competitive across the providers, and they are not egregious. So you will be able to there won't be an outlying cost there. And in fact, you would probably save some of the cost trying to find these managers yourself. And so I think, in terms of the availability of these managers, of trying to access the diverse population, the fund of funds way is a very efficient and effective way to accomplish that objective. In terms of the sort of the OCIO model, it doesn't necessarily apply, or it's not directly applicable, because the OCIO model is a bit more global, and so they're not necessarily diverse manager focused. They can do it, but it's not typically how they design their business at the outset. Fund of funds designs their business to focus on diverse managers. So that's the biggest difference.
Thank you. And what?
Go ahead. I'm sorry.
No. So actually, I mean, when you mentioned the fees, and that is something that kind of ties back into what everyone said at the beginning in terms of like values and what we're trying to get done. And so if, the priority, for example, is to kind of grow the pool of diverse managers, like this is one of the ways that you could do that. And that is the cost of doing, right? Like of doing that. So kind of taking that into consideration and thinking about, again, from the outset, what is it that we're trying to get accomplished? And so that's why very often that North Star, that values alignment from the get-go is so important, because that's the thing you have to keep going back to as you go through the process as well. So, okay, so thank you very much for that insight. So now that we have some framing for the models that are out here in general, and even a little insight on kind of how they're stacking up on this impact investing and racial equity approach, we'll take a deeper layer. And so I'll just kind of throw this out here to the full panel. And as you're seeing these partnerships, right, like different ways of structuring partnerships between traditional consultants and some more of the different approaches. When do you think it's best, or what have you seen in terms of how it works when asset owners use specialists, or when to use a generalist, right? Like, is it in the development of the overall strategy, or is it, hey, we need to have a certain thematic expertise in doing this work? So what's the balance that you're seeing, or how do you recommend some of our participants today think about when to go general, when to go specialist, and how does that start to fit into some of the models that we've just talked about over the last 30 minutes or so? And anyone can feel free to answer that.
Well, I can jump in, Erika. We're seeing some different vehicles be attractive for different kinds of funders. We're seeing funds are attractive. We've just been talking about those fund of funds, but we're also seeing what are called faux funds. So they're not really legally funds. And we're seeing foundations get excited about that because they have a lot of the attractiveness of investing in a fund in terms of portfolio diversification, but they don't have all the legal work needed in an actual fund investment. We're also seeing what I like to call a lot of parallel play. So for those of us who've had toddlers, 2-year-olds, there might be some of you on the call who are parents. You'll remember when they're 2, they can play in the same sandbox, but they each have to have their own truck. So we're seeing foundations work together in a beautiful way where they're in the same sandbox, and that sandbox may be racial equity, racial justice, climate change, maybe the sandbox may be geographic, or it might be about food or regenerative agriculture, whatever their particular mission or priority is. We're seeing that they like to be in the same sandbox, but they all need their own way, an own vehicle, own instrument to invest. So we're seeing that work really well because every foundation is so different in terms of governance, in terms of structure, in terms of staffing. So the funds are great because they're set up and you can just invest in them, but they're a high legal bar. These faux funds are really attractive. And then this parallel play where we're all in the same sandbox, but we're all doing our own thing and we can get out of the sandbox whenever we want. So we're seeing those kinds of collaborations happen. We do recommend collaboration in the field of impact investing. Like you heard at the start of the panel, all of us have been at this for a long, long time. So there's no need to kind of wander in the wilderness and try to figure this out on your own. There are experienced asset managers. Orim's talked about them with billions of dollars of assets under management. So don't let anyone tell you that they would move their money to a woman-owned or a person of color-owned investment management shop, but they just can't find any. That's not true. So we're really seeing great collaborations happen where maybe a foundation that's been on this journey for a long time, like Nathan Cummings Foundation, they've been at it for 19 years and they've published their learning journey on their website. You've got the FB Heron Foundation's been at it for probably about that long, and they've also published their journey. There are a handful of other foundations that have, the Sorensen Foundation out of Utah, they've published really excellent how-to toolkit, how to align your mission with your values. So we're seeing a lot of peer learning through your association, like the Philanthropic Association here. There's great ways to learn together. Besides having to do like official collaboration, which can be challenging for foundations to all of their different schedules and different norms and different ways of doing things. We're also seeing just learning circles, although that was more popular a few years ago. We're seeing most folks who want to learn very quickly move to doing. Because while Bert said, and I love that quote about, power down to power up, Bert, that's great. There is a crisis here in terms of racial justice, and we can't wait. We couldn't wait 10 years ago, Erika. We certainly can't wait now. So we do have to move quickly to move that big chunk of money, that 95% of assets in line with mission.
Anyone else?
Sure, I'll jump in. So I'll go back to what I kind of started with about where your organization is at and what your priorities are. And it is a learning journey. And it can be overwhelming to read some of these reports of people who have been at it for 10 years. And you're like, oh my gosh, how am I possibly going to get to there from where I am today? And you're not. So start where you're at. Start with whatever level of consensus you have and build from that. And I would say if your focus is more on your traditional assets in a traditional portfolio and you're looking for incremental alignment, and thematic alignment, then working with your existing traditional providers is typically where an organization starts. And and this isn't always a bad thing. You're challenging the financial system to step up and meet these needs is exactly what needs to happen. And bring them along with you and have them develop their practices. And a lot of organizations have gone through this in response to their clients demanding that they, meet these needs. So that's one often typical step. And then as you gain knowledge and comfort and staff capacity and some expertise around it, then you can go to the next step, which is how do we want to take this deeper? And at that point, you might do an RFP where you're now looking for either an investment advisor who has more expertise in this area, or you might go to a more collaborative approach. Or if you're at the point where you're actually taking a portion of your corpus and putting it into a dedicated portfolio for impact, and if for some organizations, this might be a program-related investment pool, where now the overriding priority is charitable intent and impact over financial return, that takes a very different path. There you're going to need not a traditional investment consultant, you're going to need community investment and impact specialists. Some carve off a portion of their endowment for still seeking a market rate of return, but aligned in deep impact. And there you might have a specialist involved to help source. Like I know I sit on the California Endowment's Mission-Related Investment Committee. They partner with a group in New York called Flat World Partners. Flat World does all the screening, market scans, due diligence, bringing opportunities that align with their theory of change. And the California Endowment's been at this for 10 years. They have staff of 3 people focused on this and have developed their North Star and their policies and their guidelines and investment committees with expertise. So again, it's a transition, it's a learning. You got to figure out what's right for your organization. Don't bite off more than you can chew. Working with your existing consultants isn't always a bad step. And yeah, I'll leave it at that.
I'll just add, and I agree again with what Susan and Bert have said. I currently am working with a cohort of faith-based plans to effectively translate their mission and values into their investment program. And while you would think that they would be far along in this journey, they actually are not. They're stuck in the 20 years model of the term escapes me, but avoidance of no sense stocks, no this, no that, none the other. The world has moved to integration. The world has moved to racial equity, to gender-based investing, and also ESG investing. And so what we're trying to do is meld their values into the SDG, the UN Sustainable Goals, to move them into a more mainstream platform. So I say that to say it doesn't need to necessarily get overly complicated. As Bert kind of pointed out, you can start with your general consultant, but the general consultant's mantra is that if I'm not asked for it, I'm not going to do it. I'm not going to volunteer it because I'm not getting paid for it, and then I've got to devote resources back at the firm to functionally be a subject matter expert. And if not enough clients are asking for it, we'll just keep moving the ball along. Just understand that dynamic. And again, when I'll go back to my spring training reference. Some of you, true impact investments, some of you will get them, will be approached, and they may be local. They may be definitely sort of generic to your mission. It's going to be hard to find a consultant to focus on those direct impact opportunities. So what you should do is utilize the resources you have. You can pick up the phone and call a manager if it's a fixed income. If you're being approached to produce a market rate real estate opportunity, you probably have real estate managers. Pick up the phone, call them, and use them as a reference. Many of you have experts on the grant side that you can use when it comes to some of these investments. So you kind of have to, as these things come, you kind of have to think about the box. Obviously, the governance is going to be really important, so you don't want to lose that component. But use all the resources and tools in your toolkit to get where you want to get. That's hopefully helpful.
All excellent advice. Thank you. So before we turn attention to the more tactical questions around RFPs and embedding racial equity in that process, I wanted to make sure that I paused and ask if there are any questions. So I know there have been some questions in the chat, so feel free to drop more there if you have them, but just wanted to see if there were any questions that folks wanted us to surface as well. So I see one here. Is there a way to invest for racial equity through blockchain? So don't really understand blockchain, but it seems to be fueling white nationalism from what I've read because it's not easily traceable. If this takes us on a tangent, don't worry about it. I don't know enough about blockchain to answer that question, but I don't know if any of our panelists have any exposure to or understanding of blockchain to be able to answer that around the racial equity question.
I know a bit about crypto, having sold a lot of it for Silicon Valley Community Foundation, and have followed to some degree developments that use blockchain for good, for charity. And I have read about a few case studies, like providing an alternative form of cash to a community of women who were bartering, and then this helped monetize it. But I don't know. I can't give you any specifics, like there's something I could direct you to right away.
I would just say, and I've looked at this for a number of years, have invested a little bit. I would say that you should have your general consultant give you as much information as they can on it. Blockchain, in terms of by its very nature, is meant to be decentralized and not beholden to sort of the old world kind of. So you don't necessarily need to graduate from those two schools to be an active operator in the blockchain world. And so there are a lot of diverse players in the blockchain world. So you'll have to approach it a little bit differently. Because it's a different asset, and B, trying to get to the underlying players and ownership structure of the individual companies related to the blockchain is a little bit difficult. But from an asset allocation, or should you should you investigate it? I would say most definitely, because I think it is going to be a very potent asset class going forward. And that's a little bit of a tangent, but yeah.
Eric, I did want to address one of the question about a faux fund. And I just wanted to make sure people didn't read that as faux as in fake, because what LISC is doing and other big national CDFIs having initiatives like the Black Developers Fund or the Entrepreneurs of Color Fund. I mean, those are very legitimate, great impact investments. The fact that they're initiatives that are funded by their general revolving loan fund that you're investing in as an investor there's nothing wrong with that structure. I just want to make sure people understand that.
Thank you.
Thank you.
And I should also say that I got that word from LISC. So they're using that word to describe it. So, but you're right. It is a totally legitimate, actually very seamless way to invest. And it's really another example, just to get off of LISC, would be the some of these place-based fixed income funds like RBC Access, which is about $1 billion strategy, place-based strategy. They've created different sleeves that are virtual sleeves. So you could call those faux funds too, but they're virtual sleeves in a particular place. There's one in Minnesota, there's one in Northwest, there's one in California, and there's a new one in New Mexico. So it's where the foundations can come together and say, hey, if you come here, we'll invest, and then we can keep some of our fixed income assets here at home rather than on Wall Street. But those are all structured as virtual funds. That's maybe a nicer word, Bert.
Thank you for the clarification. I appreciate it. And Tina had a question earlier and it was being answered in the chat, but I'll just surface it nonetheless regarding whether or not traditional investment consultants can gain access to fund of funds. So Bert, you indicated yes, as did in Orim, but there's sometimes a little bit of a tricky situation to navigate. So Orim, can you talk a little bit about your response to where the conflict may exist in that?
Yes, and because the fund of funds space gained so much traction, it became attractive to your traditional consultants, and traditional consultants do have a manager search engine. It may not be as in-depth as the fund of funds providers. Typically diverse firms can get screened out for both qualitative and quantitative method or measures, and so what happens is, if a traditional consultant wants to start a fund of funds product, they will potentially look at other fund of funds managers, get a pool of their product assets, their product managers, and then replicate those managers for the consultant's own product. So that's why it can get a little tricky there.
Thank you. So we just had a question about whether there is a director of minority and women-owned asset management companies. So yes, there is. That's publicly available on the Emerging Manager Monthly website. So I'm just going to drop that in the chat as well. So also get yourself a subscription to Emerging Manager Monthly, because that is a publication that really just does spotlight and kind of lift up some of the firms that you may not see, but also some of the, mostly pensions, but some of the investors that are developing different strategies as well. So it's just an additional resource to add to your, yes. Okay,
And
so they have, go ahead.
Yeah, and the Diverse Asset Manager Initiative, DAMI, is another source of not necessarily a list, but of participants and asset managers and foundations participating in that initiative. And then the Knight Foundation does an annual survey of the top 50 foundations and who are leaders in allocating to diverse managers. And so you can often go to their websites and see who they're investing in.
There are also, I'll just quickly mention two other resources. The National Association of Investment Companies, they will have a group of private equity firms. And my old firm, NASP, the National Association of Securities Professionals, will have a pretty good batch of diverse managers.
And I will also say that both of those organizations hold events, annual events, or will work with potentially a group like this to have like even a more focused conversation, either with members or just to help think through where some opportunity exists as well. So collaboration.
I just wanted to add some impact oriented resources that they're impact funds and with a racial justice lens. So that would be Big Path Capital, and they have conferences and events. Some of them are only limited to investors, to LPs, so you have to kind of go through some screening to go. But they have they've been doing diverse asset manager showcases, as well as Gratitude Railroad. They've also been doing some diverse asset manager showcases that also have an impact lens. I'll put those in the chat.
Okay.
Thanks, Bert.
Okay. All right, so we are going to now shift to a conversation about RFPs, what to look for, what to include, how to think about that process as well. So we started the conversation level setting for racial equity, and so coming full circle, although it has been part of the discussion all along, and want to now think about some of the considerations for assessing how well potential consultants may be able to help you advance that work. What are some of the questions that you may want to include? And even thinking about your role in the ecosystem and how to use this process for, I think, some important signaling, not just to peer organizations, but to the field in general as well. And so one of the things that I'm happy to share is a framework for thinking about racial equity in your process. And some of these questions that are in the framework actually may be useful for how you want to approach your RFP process as well. And then I'll ask each of our panelists to talk about an example of when they've seen or experienced when the RFP process was leveraged for real impact, really, in the system, where leveraging the influence of asset owners to actually make change within the capital change or chain or within the system overall. So I will start with sharing my screen and walk really quickly through. Here we go. The racial equity assessment framework that I've developed that really just kind of thinks about understanding where a process is on a spectrum from colorblind to equity focused. Colorblind being there's really no discussion, no consideration or strategy that would be focused on diversity, equity, and inclusion. Diversity only being when organizations or a process is focused more on representation, but not inclusion or equity. The race tentative approach is when there is a much stronger sense of inclusion, but there's a tentativeness in terms of kind of leaning all the way into equity. Like there's a hesitance to kind of name, frame, and then act in terms of equity. And those equity-focused organizations are the ones that are leading with race and kind of looking at the intersections of race and other forms of identity and using the tools to transform the policies and practices of their organization. But really the areas that you may want to be thinking about in terms of engaging consultants and starting to get a sense of where they may be able to help you and some of the signals that can tell you whether or not there has been deep work within an organization are going to go along some of these areas, these features of racial equity. So understanding whether or not that firm itself, the consultant, has a stated commitment around diversity, equity, and inclusion. And have they done any work to kind of develop an understanding of how they might advance equity as a player in this space, as an actor in the ecosystem? Is policy and practice, or is the policies of the organization? You can't necessarily dig into this with a consulting firm, but just have a sense of like whether or not that is prioritized in the way that they are sort of documenting their process. Like, what can they give to you to indicate that they are clear about prioritizing some of the ways that they approach their work as a matter of decision making, whether or not DEI is prioritized, and that's around race and gender as well. Are there accountability mechanisms within the relationship that you have with that potential consultant? But, is that built into their process as well? Is there an individual who's responsible for sort of thinking about equity and, for example, manager due diligence, or is it just really embedded in the process? And everyone's job is to move this work forward. Data, and is that being collected and disaggregated by race, by gender, by geography, if there's an interest in a place-based strategy, but what are the practices and how will you know that you potentially will get the information, the data to inform your decision making, and how they're using that as a matter of practice and habit. Stakeholder engagement, this goes to sort of like where folks are hanging out, where they're spending their time. Do they know these organizations, even that we've mentioned, sort of, the NASP and the NAICs of the world, as related to different identity groups that are operating in the field. And so you can ask those types of questions to get a sense of what they might be able to source, or where their natural networks exist. In terms of outcomes oriented, is there, in terms of the relationship with the potential consultant, or even the work that consultant is doing, do they have a sense of where they'd like to move this work in terms of the relationship with you, but like how they are operating in the field around racial equity in their process, and what it is that they're trying to ultimately move, again, back to that stated commitment. The learning culture and community of practice, that's not necessarily, again, something you could surface in an RFP process, but it is something you may want to ask in the interview, right? Like, are you all continuing to encourage your workforce to participate in, or is there training or something going on within the firm that lets us know that as we're growing, that others are growing as well? The narrative change and understanding how communications, or how this work is communicated within the firm, but also out in the field, where there are a few examples of firms that are very clear about how they're advancing DEI in the work that they do, and is it on the website? Is it in reports? And how can you get a sense of like how they're shaping that narrative, and is it being articulated out in the world? And then finally, again, thinking about this in terms of systems change, and what is the change that you want to affect, leveraging your role, but then also like in asking some of those questions of your potential consultants, like how are they actually changing their practices, and what is their sphere of influence, and how are they seeking to change conditions as well. So I'm going to stop sharing because that can be a lot, but there's some of the questions that you may actually want to think about or kind of revising for your own process, or thinking about including in an RFP process. It's going to draw out the practices that will get a different outcome. So I think we've all talked a little bit about, sort of the, I'll use faux in this case, some of the faux practices that may start to surface, because everybody's recognizing that these are priorities, increasing priorities for asset owners. And so folks are trying to respond to the market, but not necessarily actually responding to the need. And so just want to, before I open up to the panels and asking for some of those examples, are there any questions about either the framework or how to potentially leverage that as well?
Erika, this is Tina. Just some folks have texted me that they have their Q&A disabled at work, so they can't chat. So if folks, I think, might have some questions whenever they're ready to ask those.
So let's push pause and open it up for questions as well. And then I don't know if yeah.
I had two quick questions, and I know we've gone past these topics, so feel free to circle back at the end. I don't want to like disrupt the flow. But two things that popped out was, Susan, can you explain again the faux funds, the faux in the good way, and just sort of what exactly they are and how they are distinguished from traditional funds? And the second question was on the fund of fund topic. Can anyone speak to just what the fund structure looks like from a fee standpoint? What do fees, how are fees structured? What are fees like look like compared to market, and how does it feel to actually invest? Thank you. Sorry about not being able to use the Q&A function.
Want me to start, Erika, and then or
Yes. So Susan, if you can answer the first question about the faux funds, and then Orim, if you want to take on the question about the fund of funds and structure.
Yeah, so the good faux funds. So it's all about decreasing barriers to entry for impact investing. So one of the biggest barriers is cost, and that comes into like legal cost. Also, there might be instruments that aren't that are unfamiliar to investors. So a faux fund, in a good way, means let's call it a virtual fund. So that's where an entity, an issuer, might not want to go through all the trouble of cost of launching a actual legal fund that is a special purpose vehicle that has a structure that you have to have all the legal documents and all your ducks in a row. They might just want to use their existing entity, such as LISC. And that way, the investors, it makes it easy for them too, because they can make a direct investment into LISC. LISC then holds the money on their balance sheet, but in this case, it was non-recourse to LISC. So it's a special type of structure that makes it a lot easier, I think, on both parties to manage. An example of an actual fund that just launched is called the Minnesota Inclusive Growth Fund, which actually is an LLC and a separate legal entity. It is an actual fund, and that took much longer to create, much higher expense, and then all the investors had to wade through all these legal documents that they maybe were unfamiliar with. And to Bert's point earlier, the traditional investment consultants really are unfamiliar with all of these kinds of structures. So a lot of the foundations were trying to wade through all this on their own, which was challenging. So it's much easier to have a streamlined kind of virtual fund. Another example would be the RBC Access Capital creating these kind of virtual sleeves of their nationally diversified mutual fund for place-based investors. So for example, in New Mexico, they create a New Mexico sleeve of RBC Access. So investors still get the benefit of buying into the mutual fund, meaning, back to parallel play, they're in the sandbox, but they can leave. They can take their truck and go home anytime they want. They don't have to ask somebody else, hey, will you buy my shares? They can come in and they can go out because it's a virtual sleeve. However, RBC Access promises to invest their money in the counties that they have specified. So they still get the kind of financial diversification benefit, but they also get the targeted impact benefit. So we're seeing these kind of creative funds start up in addition to all the many new funds that have been starting up that are particularly, I believe about half of them are led by women and people of color, which is incredible. So this fund of funds structure is also a great way to go, especially if you're looking at some of these emerging managers.
Yes, and in terms of the fees, you will pay a premium, obviously, to again, I think I've mentioned versus just a sort of a generic, let's call it a S&P 500 strategy. The gradation or the increase in fees will generally go as they do in the generic environment. So you'll pay more for global exposure, you'll pay more for small cap. I will tell you, you probably wind up paying about 20 basis points more for the fund of fund structure. But again, it depends on your individual fund's size and your allocations to both the fund of funds and your generic, your non-fund funds strategies. So the fees are, again, not, they don't approach 1% or even 75 basis points. They're lower than that. But you will pay a bit of a premium again for the benefit of accessing and the ease of accessing multiple diverse managers. Hopefully that answers the question.
Do we have any other, I don't want to miss any other questions about that folks aren't unable to access the chat? Okay. So turning back to the panel, you know, again, leveraging influence as an asset owner, as an allocator, can be a catalyst for some pretty significant systems towards equity. And so as we head towards the end of our conversation here, I really do just want to give each of you an opportunity to talk about a time when you've actually seen that happen. And so I think it's important to note that just because a current partner doesn't necessarily have the expertise, you can actually influence a change with existing partners as well. So it's not necessarily just like, oh, you got to get rid of everybody, but you can challenge partners to step up, build the competency, the skills, and the resources to move towards equity, because ultimately that's what we want everybody to be doing. And so I'm going to ask each of you to share an example that you've seen or that you've actually experienced where that leverage resulted in a pretty significant change. I mean, Orim, you talked a little bit about, pensions, getting it early. And I think that's a great example. But Susan, let's start with you. If you've got an example of when you've seen that happen.
So many examples, but I'll just talk about one very simple one and one that just happened. So one is with a client who so committed to racial justice that they're weaving that throughout not just their grant making priorities, but their investment priorities, but also how they do their work. So they're really trying to kind of walk the walk and kind of move through your framework, Erika. And so when they look at investment managers, like an impact investment manager, and I sent them a deck of a potential impact investing manager, and they took a quick glance through it and they said, sorry, we're not even going to consider this because there is no diversity on this team whatsoever. And I will say for emerging fund managers, this was a tiny fund. I think it was even like $1 million or $2 million. It's very hard to have to show a diverse team because usually emerging managers of a small fund like that, there's like 2 or 3 people involved. Still, they didn't show any advisors or mentors or that no one of that was a diverse individual. So this client said, we're not even going to look at that. So to have that as a hard rule is kind of an interesting, clear line to take. I will caution though that according to your diagram, Erika, that stuck in just the representation, just having a woman or a person of color on the team doesn't necessarily mean that they're on the journey in an authentic way. But that's one thing that foundations can do. Your grant makers, your investors. So you can use your power as an investor to say, if you don't have a diverse team, I'm going to look at it. The second example just happened. And Erika, when we were on the panel together, another one you organized in New York all those years ago, and we were talking about diversity in endowment management. I remember walking into the room and there were a couple of people in the back and they said, oh, great, we're so interested in talking about diversification of assets. And I said, yeah, not that kind of diversification. And they left. And it got me thinking about how we do a lot of preaching to the choir in these discussions. So we're talking to a lot of people who already agree with us. So I had occasion the other day to be on investment committee, and it wasn't my turn to speak. It wasn't the impact investing part yet. But so this committee of all white men, you know, God bless them, they were grilling the investment manager about their lack of diversity. So the all white men were yelling at the other all white men, and I was just kind of on mute, kind of slowly dying in the background. But you know, good for them. They're asking the question, and they don't, you know, your framework would be so helpful for them. Like they're very early in their racial justice journey. I think Orim mentioned that we're in spring training. I'm not sure they're in spring training. I think they're trying to get to spring training. So I guess they're in the minor leagues. But you know, we're really seeing these committees are starting to ask the questions. And the issue was the manager kind of tap danced, and then he had his investor relations I don't know, assistant or manager on the call, and that was a woman. And so then she tap danced through that, you know, the answer. The answer was they had no diversity. So I do think that there is huge power to investment committees asking the question, and then, but then they've got to look at themselves. So it isn't just kind of one-sided.
Thank you. Bert, did you want to?
Yeah. So, you know, there's a number of areas where an asset owner can make a contribution. And if any of you have studied the impact measurement and management principles, there's this concept, one of the 5 dimensions is, what is your contribution to the impact? That can be leading by example, influencing others, allocating capital, seeding new investments that others wouldn't, de-risking investments, bringing in other investors on a deal. So there's a lot of different ways that you can have larger systems level change. I'll give the example of my experience and how I met Erika 10 years ago at Silicon Valley Community Foundation, where the focus was on the consultant, that across the field, investment consultants were acting as gatekeepers and not door openers to allocating to diverse managers. And so we intentionally, you know, started with the investment committee and staff explaining how this fits in with their fiduciary duty of accountability, transparency, their duty to the mission as a charitable organization, and why it was not only a smart thing to do to consider all high-performing managers, regardless if they're women or minorities. You're leaving alpha on the table if you're not. So first, educating ourselves, then challenging our consultant to say, hey, look, we are going to measure you every year. We want you to ensure us that your process is inclusive across race, ethnicity, and gender in finding managers, vetting managers, and bringing them to us. And we want you to report to us every year those metrics. How many did you meet with? How many did you vet and recommend? And how many ultimately got hired? And if we're seeing in that funnel that you can't find any, then we need to have a conversation about finding another consultant. If you're finding them and bringing them to our committee and we're rejecting them, we need to have a conversation with the committee about your role in this. So to the framework that Erika, you know, showed, data collection, accountability mechanisms, adding it to your policy under roles and responsibilities, and then adding it to your investment consultants' scope of services as part of what they're responsible for delivering to you, are all ways that you can greatly influence the field. And then every time you meet with a new manager, regardless of if they're diverse or not, ask them the same questions. What are you doing at a firm level? Like, what's your ownership? How much is women? How much is diverse? How about your key decision makers? How about your staff? What are you doing what's your manager due diligence process look like? What are you doing to influence the field as a firm? So just incorporating it into part of your ongoing practice and dialogue and discussion is starts to influence. Oh, and then one other point is a lot of small foundations say, how can my capital possibly make a difference? And I just want to remind you that, you know, philanthropy is often the thin edge of the wedge, and that this happens in investments as well. And that if you're seeding a first-time fund manager, that then opens the door for them to be on a fund of funds platform and take on larger capital. So they need capital to start somewhere, and it's often the small family offices and family foundations that are willing to take that risk and move the needle. Thanks
so much, Bert. I'm going to drop in the chat the case study from Silicon Valley Investment Manager Diversity, the hardest taboo to break, which includes those questions and some of the framing that Bert just shared. So it's evergreen. It was published, I think, back in 2012 or 2013 sometime, but it's still useful today. Orim, you know, talk a little bit about what you've seen or experienced as well.
I'll talk about what I've experienced, and I will keep it brief. And before that, I fundamentally, wholeheartedly agree with what Susan and Bert have said. I mean, there's really nothing more technical that I can add to you know, the commitment. What I will say is, in my experience, the best indicator for change, and success is commitment from the top. You can dress up a lot of charts, graphs, scholastic understanding, studies, blah. The best indicator for success is commitment and drive from the top. And I could cite numerous examples, but I'll give you a bit of a history lesson. The public finance industry in the early days was, again, pale, male, and stale. It basically had no diversity, no representation, etc. So as you know, African Americans got the right to vote, started voting, started electing mayors of big cities. Those mayors appointed individuals as their chief financial officers, treasurers, etc., who then had to select public finance firms to handle the business of the city. And many of those mayors, Maynard Jackson being one, Hank Parker as treasurer of state of Connecticut being another, Coleman Young, it goes on, would often get told that, as you know, these presenters came in, there was no diversity. And as you can imagine, in the early 70s, that was the case, because, you know, African Americans, their evolution in this fight has been, you know, on a different plane. And so in the early days, those treasurers and CFOs told the firms, if you don't have anybody that looks like me in your presentations, you shouldn't even show up. And so guess what? That sector, public finance, has the largest representation of diverse and women in the sort of profession. That's where it all started. And so then it evolved into the asset management industry as some of these the individuals gravitated to investment committees of the public fund boards. And so you had more of a push there. So again, the direct push was responsible for bringing African Americans in mass into the public finance business. And you'll see it there today. You go to any firm, if you don't have at least a good smattering of African Americans in the public finance department, they're really not doing a lot of business. They're not a prime mover. And I'll give you another example. And this is a little bit, this is an interesting one. So to Susan's point about representation, I sat through a consultant search, and each of the firms were pretty much white men. One of them had a woman, and one of them had an African-American woman. And throughout the presentation of the firm with the African-American woman, there were 3 white guys, 2 in the room, 1 on screen, who did most of the talking. So they left, the presentation was an hour, 90 minutes, hour and a half. The white guys took an hour and 15 minutes to talk about background of the firm, ownership of the firm, manager research, all of the technical aspects. And they left the African-American woman 5 minutes to talk about performance reporting. What's wrong with that picture? So I was the only African-American on involved in the selection process. I didn't vote for it because to me that was offensive, and it was I actually was just hopping mad, and so I couldn't, I just couldn't, So that's kind of it's an interesting dynamic, but that's some of the actual practicalities that you will see out in the market today. So you have to be aware of both sides of it, I guess. Hopefully that was helpful.
I think so, because that's a real part of this process, and not just what it is that we're seeing or putting in this RFP process, but kind of what we're experiencing or what folks are experiencing in terms of the partners that we choose. So that is it for the discussion, and we have kind of almost come to the end of our time. So before I kind of wrap this up, I want to find out if there are any more questions based on any aspect of the conversation that we've had today. We'll make sure that the resources, the slide decks are available to everyone after. And I believe the recording will be available with Philanthropy Network. Okay, so the recording will be available after as well. And so thank you to our panel. Thank you so much, Susan, Orim, and Bert. This has actually been fun for me to sit here and chat with you all. I feel like all we needed were some drinks, so we could have hung out at the bar with this one. But I also want to thank Tina for creating this opportunity, and thank Philanthropy Network for again providing the space and the platform for an ongoing conversation. Right? Like, I know this isn't the start and this isn't the end as well. So I'm definitely appreciative for the opportunity. So before we close it out, I just want to find out if there are any other questions. Either drop them in the chat or feel free to come off mute.
Hi there. This is Vanessa Lowe. Can you hear me?
Yes. Hi, Vanessa.
Hi there, Erika, and everybody. Good to see you all. So I actually came in late, but I would love to share this with others. Is this only for Philanthropy Network members, or will the recording be available and I can share it with my denominational endowment committee? That's who's been asking for this.
Tina, I think that's a you question. Like,
That's a good question. This was open to non-Philanthropy Network members, so I would imagine it would be fine to share with others.
Thank you so much.
Sure.
Okay. Tina, I don't know if you had any closeout as well.
Just a tremendous thank you to all of you, asking the questions and raising it and continuing this conversation from the perspective of the cohort, and many of us who are committed to thinking about our mission-aligned investing. Just want to thank all of you for this and are excited to continue to move to action.
All right. Well, thanks so much. Have a wonderful weekend.
Thanks, everyone.
Thank you all for the invitation and the time. Thank you.
Thank you.
Thank you.
Bye all.
Checking out.